Welcome back to the Working Thesis. Today is Monday, July 6th, 2026. Grab your coffee if you're commuting, because we have a ton of ground to cover. I'm Maya, here as always with Theo. Last week, the market felt like it was playing pure defense, bidding up safe havens, hiding in utilities, and seeking rate relief. But today, the tape flipped hard to risk on in a single session.
It was a textbook, violent reversal, Maya. You could feel the sentiment shift right from the opening bell. Did the market spend the weekend drinking espresso? Because the energy today was entirely different. We came into Monday morning and capital was just rushing back into the fastest moving parts of the market. The headline everyone is staring at right now is the Dow Jones Industrial Average. It closed at an absolute record today, completely clearing the 53,000 level for the very first time in history.
The first close ever above 53,000. It is a massive psychological milestone. It is one of those big, round numbers that makes people stop and recalibrate. But underneath that headline index level, the engine of this rally completely shifted gears. The cyclicals and the semiconductor chips roared back to life after pausing last week.
They absolutely did. But the tension in today's story, and this is what we really need to dig into, is that while the chips came roaring back, the software sector did not confirm the move. We had this huge rotation narrative building up over the last few days, and today, that rotation hit a brick wall. That divergence between hardware and software is going to be the central thread we unpack today. First, a quick and honest word. Everything you're about to hear is really just the two of us thinking out loud. Personal market commentary, made for learning and for fun. It isn't investment advice, and it isn't a recommendation.
And when we talk about a specific company, it's only ever to make a bigger idea click, never a nudge to buy or to sell. So take it as a starting point for your own curiosity. Do your own research and make the call that's right for you. Let us look at the scoreboard to see exactly how this played out across the major indices. As we mentioned, the Dow led the narrative, closing at 53,056. That is up 0.29% on the day, securing that historic first close above 53,000.
It is an incredible number to say out loud. Think about where we were just a few years ago. The broader market was right there with it, though not quite making the same historic headlines. The S&P 500 added 0.72% to close at 7,537. The Nasdaq Composite had an even stronger session, gaining 1.12% to finish at 26,121.
And we also saw strength in the small caps, which is always an interesting data point for market breadth. The Russell 2000 was up 0.45% today, pivoting right around that massive 3,000 level. It seems like the market is very comfortable operating at these high altitudes right now, rather than getting vertigo.
That comfort is perfectly reflected in the volatility index. The VIX dropped about 3.6% today, settling back down to a complacent 15.6. The market is just not pricing in a lot of near-term fear or systemic turbulence.
Just as a point of neutral market color, if you look at the Dow, its Relative Strength Index, or RSI, is sitting near 71.
Right, which means it is technically extended. An RSI near 71 is an objective data point on the tape showing how relentless this momentum has been. It is an extended market, but as we often see, extended markets can stay extended when the macro winds are at their back.
Exactly. It is just a structural reality to keep in mind as we contextualize this 53,000 milestone. Let's dig into the individual sectors.
The sector flip today was incredibly pronounced. We saw a massive bid in cyclicals. Financials were up 4.8%. Communication services rose 3.8%. Consumer discretionary gained 3.2%. And industrials added 2.4%.
And on the flip side, the defensive areas took a hit. Real estate was down 2.1%. Utilities dropped 2%, and energy slipped 1.3%. This unwound last week's rate relief defensive trade in a single day.
This is the bond proxy mechanic at work. Utilities and real estate investment trusts generally behave like bonds. They pay a steady dividend. So, when the 10-year Treasury yield firmed up today to around 4.48%, those bond proxy sectors instantly sold off.
Let's break that down just a touch more for the listeners because it is such a foundational market mechanic. It is essentially a yield seesaw. If you are an income investor and you can suddenly get a risk-free 4.48% return from a government bond, you simply do not need to stretch for a lower dividend from a utility company. You take the guaranteed yield.
Exactly. That firming in the 10-year yield instantly reprices the attractiveness of those defensive dividend stocks. And while that money was leaving safety, risk-on cyclicals were actively being bid. It is a perfect illustration of how sensitive these different buckets of equities are to the 10-year yield. As rates found a floor near 4.48%, capital rotated right out of safety and flooded back into growth and cyclicals. Let's zoom in on financials for a second because they were the absolute star of the show today. The financials ETF, XLF, surged about 4.8%. That makes it the day's biggest sector winner by a massive margin.
A nearly 5% move for the entire financial sector in one session is huge. It is not just a subtle rotation. That is a stampede. What is driving that specific bid today?
It is a classic combination of risk-on appetite and a steeper yield curve. When you have a firmer 10-year yield combined with general economic optimism, you get a powerful credit confidence bid.
And for anyone newer to that mechanic, a steeper yield curve is essentially the lifeblood of traditional banking. Banks generally borrow at short-term rates and lend at long-term rates. When that gap widens, when the curve steepens, their profit margins expand.
Spot on. The market is essentially voting that the banks are going to see healthy net interest margins and strong loan performance going forward.
So it is less about defensive posturing and entirely about betting on economic resilience. The steeper curve gives them the fundamental structural tailwind, and the broader risk-on sentiment provides the immediate momentum. Speaking of capital flooding back, let's talk about semiconductors. They rebounded today for what looks like a very strong second leg. The semiconductor ETF SOX was up 2.7%, and the SMH ETF rose 2%.
The recent AI hardware deleveraging that we saw last week completely paused today. It was like last week's fears just evaporated. Let's look at the individual movers because the moves were incredibly sharp. AMD jumped 6.6%. Western Digital rose 7%.
And it wasn't just the memory and CPU names leading the charge. The foundries and the networking companies joined in. TSMC added 4.1%. Arista Networks surged 8.3%, and Broadcom climbed 3.7%.
These are factual, heavy moves across the entire hardware ecosystem. For the past week, the loudest narrative on the street was that money might be flowing out of these semiconductor names permanently. People were asking if the AI hardware trade was broken.
But today's price action challenged that assumption aggressively. The hardware names fought back and reclaimed their leadership position on the tape. It just goes to show how quickly capital can re-engage when the fundamental growth story hasn't actually changed, and the prices just needed a breather. But here's the tension we mentioned at the top of the show. Software completely lagged. If capital was rotating, software should have been the beneficiary. Instead, the software ETF, IGV, rose only 1.3% today, finishing well behind the 2.7% gain we saw in the SOX.
And some high-profile software names actually sold off on a day when the broader market was flying. AppLovin fell 6.6%. Microsoft slipped about 1% on headlines regarding layoffs. So the much-discussed great rotation from chips into software absolutely did not confirm today.
That lack of confirmation is key. Whenever we hear talk about an AI peak or an AI slowdown in the hardware space, it is important to frame what the demand is actually doing. The demand isn't disappearing. It is broadening and relocating. It is shifting toward optimization, custom silicon, and diversification.
That is such an important nuance. It is not that AI demand is weakening or that frontier model prices are dropping. It is just that the infrastructure build-out is maturing. Enterprise companies are in a digestion phase. They bought the hardware, and now they're figuring out how to optimize it before they blindly buy massive new software licenses.
Exactly. But on the tape today, if software was going to take the baton and lead the next leg of this bull market, today was the perfect day to do it. Instead, it dropped the baton. Software simply did not catch the bid that hardware did, meaning the grand rotation thesis remains highly unconfirmed.
Meanwhile, the AI power complex ripped higher once again. This trade just will not quit. Bloom Energy surged 8.9%, and Centrus Energy jumped 7.5%.
The strength extended across the entire grid ecosystem. Vistra gained 4.1%, Eaton was up 3.7%. GE Vernova added 3.5%, and Constellation Energy rose 2.8%.
The underlying thesis here is that power is the absolute binding bottleneck for AI data centers. You simply cannot build out these massive frontier facilities without plugging them into a grid that has the capacity to handle them.
And what is really fascinating about today's price action is that this power bid stayed incredibly strong, even on a massive risk-on day. Usually, when the market chases high-beta chips and cyclicals, you see capital rotate out of infrastructure and utility-adjacent names. They get left behind as boring.
But not today. The structural reality of the grid capacity shortfall is keeping a very firm floor under these names. It isn't just a sentiment trade anymore. It is a physical reality trade. Copper, concrete, and transformers are non-negotiable for AI growth, and the market is refusing to let go of these names regardless of the broader risk environment.
Let's pivot to commodities because there were some really interesting divergences there. Gold had a fantastic day, up about 2.3% using the GLD proxy, with spot prices trading near $4,130 an ounce.
That gold rally is directly tied to the currency markets. The US dollar index was down about 0.5% today. Meanwhile, WTI crude oil slid roughly 1.1% as the market digested OPEC plus oversupply worries.
So how should we read this combination? Gold is up strongly, but the dollar is down and oil is sliding.
The primary read here is that we are looking at a dovish dollar debasement tailwind. It is definitely not a rate scare.
Right, because if it were a rate scare where the market was terrified of runaway inflation causing the Fed to hike, gold would likely be getting crushed by higher real yields.
Exactly. Instead, we have a firm 10-year yield near 4.48%, a softer dollar, and gold catching a strong bid. It paints a picture of systemic liquidity and currency debasement rather than an acute inflationary fear causing a panic. Gold is acting like a sponge for that liquidity, not a panic room.
Looking around the globe, Hong Kong's Hang Seng Index surged 4.2%. This was a massive China risk-on bounce, led heavily by Alibaba and the broader K-Web tech names.
It is worth noting that Alibaba was deeply oversold heading into this session. When you combine an oversold chart with a global risk-on day, you get these explosive snapback rallies. Over in Europe, the Stoxx 600 also caught the global risk-on mood, closing up 1.4%.
The only real laggard on the global stage was Japan's Nikkei, which slipped 0.5% on the day. But we also saw that risk-on appetite spill aggressively into crypto.
It really did. Bitcoin gained 3.5%, trading right around $63,600. Ethereum was up 5.3%.
And the crypto-adjacent equities moved even harder, which is typical for how this sector trades. Coinbase surged 13% today.
When the market decides to turn risk on, crypto continues to act as a high beta expression of that exact same sentiment. It acts almost like a sponge for excess liquidity and risk appetite. And today, that sponge was soaking it all up.
That brings us to the big question of the day. We've been watching this narrative about a rotation from chips into software. Is it a real regime change? Or is it just a valuation setup?
Based on the tape today, it strongly suggests it is just a valuation setup. A true regime change requires sustained money flow into the new leaders, and we just didn't see that. We saw semiconductors aggressively retake market leadership, while software absolutely did not confirm.
Right. A regime change means the engine of the market has fundamentally been replaced, but today looked more like a stretched rubber band simply snapping back. The hardware names had compressed, valuations cooled off slightly, and the buyers stepped right back in. So right now, it looks like a valuation coil rather than a true money flow reality.
It is crucial to remember how to contextualize this. This is a likelihood game. No one can predict the future. It is just one read of what the setup looks like today based on where the capital actually moved.
Perfectly stated. We deal in observing realities, not predicting certainties. The data is the data, and the market data today just didn't support a structural shift away from hardware. It supported the idea that the hardware leaders just needed a brief pause, a technical reset, before resuming their trend. Let's look at the calendar, because we have a very busy week ahead of us, and today's moves are just the opening act. Wednesday, July 8th is our main macroeconomic catalyst, with the release of the FOMC meeting minutes.
The markets are currently leaning toward no July rate hike, but they are not entirely all in on that bet. You can see that hesitation in the tape today. We have a firm 10-year yield, but it is paired with a dovish dollar. The market is looking for the Fed minutes to provide some clarity.
Around July 10th, we are expecting SK Hynix's roughly $29 billion U.S. listing. That is going to be a massive event for the semiconductor space.
It absolutely is. It will give us a very clean, real-time read on the memory market and the broader Korea supply tape. It is a huge liquidity event for the hardware sector.
And looking slightly further out, July 14th brings us CPI inflation data, alongside the official start of the Magnificent Seven and big tech earnings season. Then the very next day, July 15th, we get PPI inflation data. The calendar is packed, so today's risk-on move is going to be tested very soon.
Let's wrap up with our net thesis read. Going back to our core frameworks, Thesis 1, which tracks power as the binding constraint on AI, saw its names lead again today. The bid is completely intact. We also saw semiconductors and memory successfully rebound off their early July pullback.
Looking at Thesis 5, our China framework, we saw Hong Kong bounce hard off deeply oversold levels. Across the board today, absolutely no thesis kill criteria fired. The structural trends remain firmly in place.
Having these frameworks is so helpful on a day like today because it cuts through the noise. When the broader market is whipping back and forth between defense and offense, anchoring to these structural physical realities, like the power bottleneck or extreme oversold conditions, keeps us grounded.
It really does. You watch the data, you check the frameworks, and you see if the story is holding. Today, the story held beautifully. That is a great summary of a historic session, a 53,000 Dow and a total risk-on reversal.
That is the wrap for today's market. Thanks for spending your commute with us. Drive safe, and we will see you back here tomorrow on The Working Thesis. Okay, that's our episode. The honest goal here is simple. Hold a few ideas about the world and keep checking whether they're still true.
Together, out loud, a little at a time. If you spot where we've got it wrong, please tell us. That's how this gets better. See you next time.